Welcome back, everybody, to the deep dive.
Yeah.
Today, we're going to do something a little different. We're going to take a deep dive into some really interesting market indicators.
Okay.
And these are the kind that you hear about and you kind of tilt your head and say, wait a minute, that can predict the market.
Right.
So the genesis of this was some research that was compiled by Nelson Freeberg.
Okay.
And he was focusing on the work of two analysts, Tom McClellan
Yes.
and Roger Kliminski.
Mm-hmm.
Now, you've probably all heard of the McClellan Oscillator.
Of course. A very popular indicator.
But what's really cool is that while Tom McClellan's family actually created that indicator,
Right.
his work really focuses on going way beyond that.
Interesting. So it's like he's branching out from what his family, developed.
Yeah, kind of like he inherited this toolbox, but decided to build his own tools as well.
I like that. Yeah, that's a great analogy.
And Roger Kliminski is kind of the same way. He's got decades of experience as a market analyst and a portfolio manager. And they've joined forces to create a firm called Global Investment Solutions.
Oh.
And they have a really interesting track record of beating the market without taking on an excessive amount of risk.
Yeah, it's the holy grail of investing, right?
Exactly.
High returns, low risk.
So let's look at some of their techniques. So the first one that I thought was just fascinating was this idea of intermarket correlation.
Yeah.
So it's this idea that seemingly unrelated markets can actually influence each other in very predictable ways.
That's right.
And one of the first examples of that was that gold prices can give us clues about future short-term interest rates.
Yeah, I know it seems strange.
Yeah.
But Tom McClellan noticed that gold prices tend to lead T-bill rates by about 15 months. And there's even a chart in the research showing that he used this correlation to predict a surge in T-bill rates way back when, and it happened.
That's amazing.
So it's really cool.
Yeah.
Gold is giving us a sneak peek into the future of interest rates.
So are there other examples of intermarket correlation?
Oh, yeah. There's a bunch of them. But another one that Tom found was that there's a link between inflation and unemployment.
Okay.
And he noticed that inflation leads unemployment by about 2 years. So it's like a domino effect. These things are all kind of connected.
Wow.
They're not isolated.
Yeah.
It's a really interesting way to look at markets.
So you mentioned the gold dollar index.
Yeah.
What is that all about?
Yeah, so the gold dollar index is it's a creation by Tom McClellan.
Okay.
And he wanted to see what gold was really doing, separated from, the ups and downs of the U.S. dollar.
Right.
So what he did was he created this index by multiplying the price of gold by the U.S. dollar index.
So it's like filtering out the noise
to
get a clearer signal from gold itself.
That's a great way to put it, yeah.
And that index can be used to predict both long-term and short-term gold trends.
That's right. And in fact, there's a trading system that's detailed in this report that uses the gold dollar index that's got some pretty amazing results.
Really?
Yeah.
Like what?
Well, since 1975, this system would have made over $160,000 per contract trading gold futures.
Wow.
And get this, for silver, the gains were even bigger.
Oh.
Over $317,000.
Per contract.
Per contract.
That's incredible. But you know what they say? High returns often come with high risks.
Sure.
What's the potential drawdown?
Yeah, well, that's the interesting thing. The drawdowns were actually pretty reasonable.
Okay.
For gold, it was around $15,000, and for silver, about $23,000.
Okay. So for those of you who like to play in the precious metals market, this gold dollar index is something that you should take a look at.
Yeah, I think so.
But Tom McClellan doesn't just stop there. He's got some really interesting methods for predicting short-term interest rates as well.
He does.
And this is where I think things get really, really interesting. He uses something called the Purchasing Managers Index.
The PMI.
To do this. And this is something that we typically think of as, focusing on manufacturing.
Yeah, activity level, the manufacturing sector.
So how does that relate to interest rates?
Well, it might seem strange at first, but there is actually a really strong correlation. And Tom noticed that almost every time the Fed raises rates, it happens after the PMI climbs above 56. And when the PMI dips below 50, well, the Fed typically eases up on rates.
So the PMI is like a crystal ball for the Fed's next move.
Pretty much, yeah. That's a great way to put it.
So how reliable is this connection?
Well, Freeberg back-tested this pattern, and he went all the way back to 1950.
Wow.
And he used the yield on 90-day commercial paper,
Okay.
which is, kind of like a benchmark for short-term interest rates.
Yeah.
And just by trading commercial paper based on when the PMI crossed those key levels, you would have gained over 6,300 basis points since 1950.
Wow, that's amazing.
Now compare that to a 12 basis point decline for buy and hold over the same period.
Wow. So, really understanding these less conventional indicators can give you a real advantage.
It really can.
So let's shift gears a little bit and talk about another area of Tom McClellan's research.
Yeah.
And this has to do with sector strength and how it impacts overall market returns.
Yeah.
And this is where, things get even more interesting, I think, because you start to look at what parts of the market are really leading the charge.
It's all about leadership, right?
Yeah.
Which sectors are driving the bus.
So what did he uncover?
Well, he actually built on the work of other analysts like Gerald Apple.
Yep.
And he found that the stock market as a whole tends to do a lot better when the NASDAQ composite is the strongest of the major market averages. And so to track this, he created a simple ratio of the NASDAQ to the NYSE composite.
Good.
And compared that to its 44-day exponential moving average.
So if it's above its moving average, that's a sign of strength.
That's exactly right. And Freeberg's research going all the way back to 1971 confirms this. When the NASDAQ was the leader in this way, the S&P 500 averaged a 14.6% annual return, but when the NASDAQ lagged, the return dropped to just 7.1%.
That's a huge difference.
It is.
So paying attention to sector leadership can give you a leg up.
Oh, absolutely. Yeah.
But didn't he also find a similar pattern with the OEX, which tracks the S&P 100?
He did. The S&P 500 seems to rally when the S&P 100 is stronger, and it weakens when the OEX lags.
Okay.
And the data backs this up. Going back to 1976, the returns were 15.1% annually when the OEX led, and just 10.9% when it lagged.
So it seems like when the growthier segments of the market, like the NASDAQ and the S&P 100, are showing strength, it bodes well for the broader market.
Yeah, it's like they're the leaders. They're the ones driving the market higher.
And this is where it gets really interesting. When both the NASDAQ and the OEX showed similar strength, those returns jumped to 16.2%. But when both were weak, they fell to just 7.3%.
Yeah, so you really want to see both of those indices performing well.
It's powerful stuff.
Yeah, it is.
So let's bring Roger Kliminski back into the picture.
Okay.
Now, he did some research, and he had a really interesting discovery focusing on the relative strength within 4 Russell sectors.
He did.
Right.
That's right.
So he was looking at the Russell 1000 growth, Russell 1000 value, Russell 2000 growth, and Russell 2000 value.
Yeah, a really interesting mix.
And his research revealed some really interesting findings.
It did, for sure. And that's where we'll pick up next time.
Okay, sounds good. We'll be back in a flash.
Looking forward to it.
Okay, so we're back, and we left off talking about these 4 different Russell sectors and how Roger Kliminski focused on those for his research.
Yeah, he really wanted to, dive deep into those sectors and see if there are any clues there about, where the broader market might be headed.
So how did he go about doing that?
Well, he developed this method to figure out which sector was the strongest at any given time, and his approach was to calculate the percentage change in each of those Russell subgroups over 4 different time frames: 5 days, 15 days, 25 days, and 35 days.
Okay, so he's looking at short-term momentum across these 4 different sectors.
Exactly, and then he averaged those results to see which sector was leading the pack.
Okay, so it's like a relative strength contest, but across multiple time frames.
Yeah, you got it. And it's a really clever way to get a more well-rounded picture.
But did it work? Did this strategy actually lead to any, outperformance?
The results were really impressive from 1995 onward. Using this strategy to switch between those 4 sectors would have yielded a 22.5% annualized return.
Wow. Incredible.
Now compare that to the S&P 500's performance over the same period, which came in at 9.2% annually.
So more than double the return of the S&P 500 just by switching between these 4 sectors.
That's right. It really highlights the importance of understanding, these subtle dynamics within the market.
Absolutely. But it makes me wonder why focus on those specific 4 Russell sectors. What about just switching between the broader Russell 1000 and the Russell 2000?
That's a great question. And it turns out that broader approach wouldn't have been nearly as effective. Simply switching between the Russell 1000 and Russell 2000 would have produced a much lower annual gain of 11.8%.
Interesting. So the magic really happens when you drill down into those growth and value components.
Exactly. It's like getting a higher resolution view of the market.
I like that analogy. But, we were talking about this data going back to 1995, which doesn't seem like a very long time when we're talking about market trends.
That's true. And you know what? After Nelson Freeberg published the first part of his report on this strategy, he got an email from a really sharp portfolio analyst named Patrick Cunningham.
Okay.
And Patrick had access to more historical Russell data.
Oh, that's fantastic. I love it when more data becomes available.
Me too. It's always exciting. So Patrick was able to dig up daily data going all the way back to 1993.
Wow.
And even more impressive monthly data stretching back to 1979.
That's amazing monthly data, all the way back to the late 70s.
I know, it's a gold mine of information.
So I'm sure Freeberg couldn't resist retesting this switching strategy with this new data.
Oh, of course not. He had to see if those results held up. And you know what? Even with the additional data, that four-sector switching strategy continued to beat the individual Russell components as well as the S&P 500.
That's great. So the strategy is robust, even when you test it with more data.
Exactly. It really adds to the credibility of the approach.
Absolutely. But what about that monthly data going all the way back to 79? I'm sure Patrick and Freeberg didn't just let that sit there.
Oh, they couldn't resist putting it to good use. So Patrick actually adapted the switching strategy to work with monthly data.
Okay, so instead of looking at those daily changes like we talked about before, he's using a longer-term time frame.
Right. So instead of using daily data, he used 3-month, 6-month, and 12-month rates of change to figure out which sector was leading.
So instead of switching every day, this monthly version would only require making adjustments once a month.
Exactly. Much less hectic, right?
Much less hectic. And I imagine that would appeal to a lot of investors.
I think so, too, especially those who aren't, glued to their screens all day.
Yeah. And I'm also curious to see how that monthly model actually performed because, the market moves in cycles and sometimes those shorter-term signals can be a little bit misleading.
You're right. And you know what? This monthly model actually performed incredibly well. From 1980 to 2003, it produced a 16.8% annualized return, outperforming all 4 of those Russell components and the S&P 500.
Wow. So even with a less frequent switching approach, this strategy still managed to deliver some pretty incredible returns over a very long period.
It's really remarkable, and it suggests that, these 4 Russell sectors really do hold some kind of key to understanding broader market movements.
It's fascinating. But here's where things take an even more interesting turn. Remember how this strategy initially focused on all 4 of those Russell sectors?
Yeah.
Well, Roger and Tom discovered that focusing on just 2 of those sectors provided even greater forecasting power.
Wow.
Okay, so they were able to simplify the strategy and make it even more effective.
Exactly. They found that by zeroing in on just the Russell 2000 growth and Russell 2000 value, they could get an even clearer picture of what the market was likely to do.
So 2 sectors out of those 4 turned out to be the real market movers.
That's right. And what they found was that when Russell 2000 growth is the relative strength leader, the entire stock market benefits.
Interesting. So it's like a rising tide lifts all boats, but only when Russell 2000 growth is at the helm.
I like that analogy, and it's not just about returns either. The risk profile also changes dramatically depending on which sector is leading.
Oh, really? Okay, so how does that work?
Well, during those periods when Russell 2000 growth is the dominant sector, the S&P 500 shows an average annualized return of 17.4%.
Okay.
But when Russell 2000 value takes the lead, that return drops to just 4.5%.
Wow, that's a huge difference.
It really is. And the maximum drawdown for the S&P 500 also changes dramatically. When Russell 2000 growth is calling the shots, the drawdown is about 21%.
Okay.
But when Russell 2000 value takes over, that drawdown more than doubles to 50%.
So not only are the returns lower when Russell 2000 value is leading, but the potential for losses is also much greater.
Exactly. It's a crucial insight for anyone who's trying to manage risk in their portfolio.
It makes me wonder what the performance of those 2 Russell sectors themselves looks like. Does this pattern hold true when you isolate those 2 sectors?
It absolutely does, and it's actually a little bit paradoxical when Russell 2000 growth is the leader. All 4 of those Russell sectors perform better.
Wow, so even Russell 2000 value benefits when Russell 2000 growth is the leader.
That's exactly right. It really underscores the interconnected nature of those sectors.
And it seems like this pattern extends beyond just the Russell indices.
Yeah.
Freeberg also looked at a bunch of different Fidelity sector funds, which cover a pretty diverse mix of industries.
He did, and you know what? Those sector funds showed the same pattern. Every single one of them was more profitable when Russell 2000 growth was leading, and they experienced losses when Russell 2000 value is in charge.
So it's not just limited to a specific set of stocks. This pattern seems to hold true across a wide range of industries.
It really does. It's almost like this one indicator gives you a glimpse into the overall health and direction of the entire market.
It's amazing how this one simple indicator can offer so much insight. But it also raises a really important question. How do we turn this knowledge into action?
That's the million-dollar question, right?
Yeah, knowing which sector is leading is one thing, but actually turning that into trading profits is a whole other ballgame.
It is, and that's what we're going to talk about next.
You're right. It's one thing to spot these market patterns, but actually turning that into, real trading profits is a whole different ballgame.
Yeah.
So how do we bridge that gap? Did Freeberg come up with any specific strategies based on all this research?
He did, actually. He created 2 trading models based on Tom and Roger's work. One's for investors who are a bit more comfortable with risk. They're looking for those potentially outsized returns.
Okay.
And then the other model is designed for a more balanced approach. They're still looking for solid gains, but they also prioritize a smoother ride.
Got it. So let's start with that first one, the more aggressive model. What's the strategy there?
Well, this one's built around a leveraged fund called RightX Mecros.
Okay.
The ticker symbol is RYMKX if you want to look it up.
Okay.
And Mecros tracks the Russell 2000, but with a twist. It uses 1.5x leverage.
So any movement in the Russell 2000 is going to be amplified in macros.
Exactly. That's the idea.
Yeah.
It magnifies both the gains and the losses.
Higher risk, higher potential reward.
You got it. But remember, we're not just trading Mecros randomly. The model uses the relative strength of those 2 Russell sectors we've been talking about, the 2000 growth and the 2000 value, as our buy and sell signals.
Okay.
So when 2000 growth is showing relative strength, the model says buy Mecros.
Gotcha.
And when 2000 value takes the lead, it's time to sell.
So you're basically riding those sector waves, but with leverage to amplify the results.
Precisely. And the theoretical results are pretty impressive. Since Mecros was launched back in November of 2000, this strategy would generated a 90.5% annualized gain when 2000 growth was in the lead.
90% annualized.
Yeah, pretty incredible. But on the flip side, when 2000 value was in control, it would have shown a 38% annualized loss.
Ouch. So those are some pretty big swings.
Yeah, for sure. It's not for the faint of heart.
But those are just theoretical returns, right?
True. What about the real world? Well, when you factor in the reality of, actually making those trades, those transitions, and those periods where you might be earning lower returns while you're waiting for the signal to change the model, still delivered a 30.2% average annual return since late 2000, with a maximum drawdown of 16%.
That's still pretty impressive, especially when you compare it to just buying and holding Mecros over the same period.
Right. Buy and hold actually resulted in a small loss, down 0.4%, with a much larger 54% drawdown.
So even with those transitions and those periods of lower returns, the strategy still came out way ahead.
It did. And that really speaks to the power of, combining these sector insights with active management.
Now, did Freeberg explore the possibility of shorting Mecros when 2000 value was the leader?
He did. Now, you can't actually short Mecros directly, but he simulated that scenario, and the results were even more dramatic. Shorting Mecros when 2000 value was in charge would have boosted the model's return to 47.1% annually since late 2000.
Wow. But shorting can be risky, especially in a market that generally goes up over time.
No doubt about it. It's definitely not a strategy for everyone. But what's fascinating is that Roger and Tom's research might actually give us a smarter way to approach shorting.
How so?
Well, their insights into sector rotation could help pinpoint those periods when the market is more likely to decline. So instead of just blindly betting against the market, you're using these signals to guide your decisions.
It's like using those sector insights to kind of tilt the odds in your favor.
Exactly. But we do have to acknowledge that the data set for these short-selling simulations was somewhat limited. Most of that data was from a bear market.
Right.
So to address that, Freeberg did some additional testing. He created a proxy for Mecros using data going all the way back to 1993.
And how did that look?
Well, even with that longer time frame, a short-only approach, just shorting when 2000 value led and staying in cash otherwise produced an 8.4% annual return since 93 with a 33% drawdown.
That's actually not bad, especially when you consider that the S&P 500 only gained 10.7% annually over that same period, with a much larger drawdown of 47%.
Right. So this approach might offer a way to participate in market gains while potentially reducing some of that downside risk.
Fascinating stuff.
Yeah.
But let's switch gears and talk about that second trading model, The one that's designed for those who might not be ready for leverage funds or shorting.
Sure. This one's a bit more conservative. It trades the S&P 500 index, which is super liquid.
Okay.
And what's really cool about this model is that it combines 3 key findings from Tom and Roger's research.
Okay, I'm intrigued. Lay it on me.
So first, it uses that ratio, the NASDAQ composite to the S&P 500, comparing it to its 50-day simple moving average. Remember that?
Yeah.
Second, it does the same thing with the OEX index, looking at its ratio to the S&P 500 and its 50-day moving average. And finally, it brings in that relative strength comparison between Russell 2000 growth and Russell 2000 value.
So it's like a multi-layered approach, bringing together those sector insights with those broader market trends.
Exactly. And the trading signals are pretty straightforward. You buy the S&P 500 when all 3 of those components are showing strength, and you sell or go to cash when all 3 are pointing towards weakness.
It's like you're waiting for all the stars to align before making a move.
That's a great way to put it. And it's a smart way to manage risk, so you're not just jumping in and out of the market on every little wiggle.
So how did this model perform?
Well, since mid-1993, this model generated a 15.3% annualized return with a very manageable 11.7% maximum drawdown.
So it beat the market by a pretty decent margin and with less risk.
You got it. The S&P 500 returned 10.7% with a much larger 47% drawdown over that same period.
Wow, Tom and Roger have really given us some powerful tools to navigate the markets.
We really have. And you know what else? Out of the 17 buy signals this model generated, 14 turned out to be profitable. That's a win rate of 82%.
That's amazing. It really shows you the power of combining those sector insights with those broader market indicators. You're really stacking the odds in your favor.
It's all about finding those edges wherever you can.
Well, I would say this deep dive has been incredible. I feel like we've really uncovered some hidden gems, and I'm definitely walking away with a whole new understanding of how these different parts of the market influence each other. And, more importantly, how we can use that knowledge to improve our investing.
Me too. And what really stands out to me is that success in the market isn't about finding some magic formula or, just following the herd. It's about constantly seeking out new perspectives, challenging those old assumptions, and being willing to explore those less traveled paths.
Right. Tom and Roger embody that perfectly.
Absolutely. They've shown us that those most valuable insights often come from the most unexpected places. Whether it's the relationship between copper futures and bond prices or, the predictive power of something as seemingly mundane as the PMI.
Exactly.
Yeah.
The great reminder that there's always more to learn. The market's always changing and evolving.
And those who are willing to adapt and keep exploring, those are the ones who will ultimately come out on top.
Absolutely.
Yeah.
It's been a pleasure diving into all this with you. And for our listeners, be sure to join us next time for another deep dive into the financial markets. Until then, happy investing.